Now we get to our favorite topic of Asia and China at this point in time. And one of the things that we're in the part of the cycle where bad news is good news, because bad news on the economic front means that there's going to be stimulus. But when you think about the expectations in China, everyone's talking about how Chinese growth is going to be so strong, the economy is going to be so robust. But if that's the case, then why do you need stimulus? And it keeps going back and forth. And one of the things we've been talking about just consistently is that you are going to get a marked slowdown in a significant amount of these data points. Now, you had that nice surge but following the end of zero COVID policy, but it wasn't sustainable. And that's where we see this accelerating to the downside. But it's still going to be an expansion. We don't expect things to go negative. But again, it still becomes a problem because there's such this now push to make sure that there's stimulus and stimulating. But they've been using so much stimulus for so long, it becomes very difficult to maintain that level because of those law of diminishing returns, because of that pressure and the inability to just continuing to layer on and utilize, I think, a lot of the same old tricks that they've used in the past. Just to give you an idea of what was initially is being proposed, they're planning another 1 trillion yuan special bonds. Remember the special purpose bonds? And when you look at the special purpose bonds, a lot of them went unused last year and they were front loaded, and now they are struggling to find projects. Just because you have the access to the capital doesn't mean you have the projects to put the capital into. And even if you did, is it a good project? And that's what we've continued to talk about, is the quality of the investments continue to deteriorate. So then you have a multiplier impact of below 1, which means that for every dollar invested, you're losing money on both principal and interest, which is, again, making it very difficult. So the other one is considering canceling purchase restrictions on second homes in smaller cities. And the idea is that over the next few days, we should get these plans, which we'll obviously talk about next week if they come out ahead of our econ show. Looking at some of the key drivers, when we look at exports were expected to be at negative 1.8. They came in at negative 7.5% on a USD basis. On a CNY basis, they came in at negative 0.8. Imports slightly stronger. They came in at 2.3%. On the US dollar basis at negative 4.5, but they were better than estimates. And remember, when you look at imports, that's a positive because imports are a prerequisite for those exports. So when you look at imports are slightly better than expected. This is going to be a good one to watch because it's like, all right, well, what does June look like? And remember, June is typically a fairly strong month for shipping, for ordering, because you're right in the middle of the year. You're looking at what's going to happen for summer. You try to get some of these orders out. So the question is this a bigger trend change or is it something a bit different? Foreign reserves continue to slow. That's obviously a pressure point when you start looking at the numbers. There's right or wrong, the market has a $3 trillion number in their head. So there's all about trying to stay above $3 trillion in foreign reserves. So they're at about 3.176. But that's just an important one to kind of consider when you're looking at it. Now, the repo rate it came in at 1.9%, so they took it down 10 basis points. CPI came in at 0.2, right in line with estimates. PPI slowing down a bit more at negative 4.6%. That PPI is a positive. CPI staying low is a positive. But remember, if demand was so strong, you have a natural bump in CPI. And even during that spike from activity following the end of zero COVID, you never got a big spike in pricing. And that's where it's like, well, how strong are things really going? And then back to these plans for 1 trillion yuan of the SPBs. Well, look at aggregate financing. Aggregate financing was supposed to be 1.9 billion, came in at 1.56. So again, shrinking that capacity. The M2 was expected to be up 12%, came in up 11.6%. M0 came in at 9.6%. New yuan loans expected to be at 1.5 trillion, came in at 1.36 trillion. Money supply for M1 expected to be up 5.2%, came in up only up 4.7%. So you're still seeing. So there's the commentary of more special purpose bonds. And then the market's like, but we don't want them and we're not taking them. And the private market continues to just essentially reject because they're already so levered. So a lot of these are just essentially a cycle from the state-owned enterprises where they're taking these new loans to buy off old loans, and you're just getting a replacement of loans, but nothing actually churning in the market, which is why it's not going to have the impact people are expecting. Lending facility was previously at 2.75%, came at 2.65%. Again, another reduction in terms of that. New home prices last month, they were up 0.32%. New home prices month over month only came in at 0.10. So you're actually getting another acceleration to the downside, which is why they're talking about lifting restrictions on second homes, trying to get some of that production coming up. Industrial production came in at 3.5% with estimates. Year on year was expected 3.9, came in 3.6. Retail sales expected to be up 3.7%, came in only up 12.7%. So again, missing to the downside by over 1%. Retail sales year to date expected to be up 9.6, came up 9.3. And that's interesting because you have to think about where we were in and how strong January was into February, March, given that end of zero COVID, and you're just not seeing any follow through. You're actually seeing that work its way lower. Fixed assets was expected to be investment up 4.4%, came up 4%. Property investment expected to be down 6.7, was down 7.2. Again, more issues on infrastructure, on real estate, on floor space. So jobless rates was expected to be up 5.2%, came in at 5.2. But when we have some charts on it, when you look at it in general, the younger side of unemployment was actually much worse and actually set a record at over 20% unemployment, again, pointing to some of those issues. And then when you look at foreign direct investment, it came in at 0.1, which again is much lower than expected. So now when we just put together some of these Chinese exports, you can see even though we're seeing some of these imports coming higher, the exports are expected to rebound. It's important to appreciate that seasonally speaking, they always start to increase because as you start to get towards the end of the month, people are ordering for the summer. They're going to start looking towards back to school. They're going to start looking towards, Christmas. So this is when you normally start to see those increases. Our point is that exports will go up, but just much less than seasonally normal. And if anything, a bit flatter, which just means that when you look at it, we're going to fall below where we were in 2021 and come in much lower than what is historical. It'll still be elevated versus 2014 through 2019, but just at a much reduced level, which is going to be a problem when you look at all of the other issues they're fighting, trying to drive this economic growth. And then the trade balance, as you can see, fell a little bit. The foreign exchange, as we were talking about, turned a bit lower. It's still in a fairly comfortable number, but it's important to look at some of the key issues in general because the economy got off to that good start, but things took a turn for the worse in April, continued in May. And realistically, we don't see it changing in June based on the trends that we're seeing on a lot of these leading indicators. As we talked about in the EIA show, you're seeing teapot refiners still remaining sluggish. You're actually seeing driving activity fall below where we were last year. That's not a great setup. So the growth figure it should be good in Q2, but the economy expanded only 0.4% in Q2 of 2022. So which was the result of COVID lockdowns in many of China's biggest cities. So when you get this big number, you have to appreciate it's like, well, Q2 last year was horrendous, and even 0.4 is probably an utter lie when you look at just how bad things were at that point in time. So given that low base, the headline figure should be fairly good, but will the data be enough to convince Beijing the economy is on the path of a sustainable recovery? And because we're starting to see an accelerating amount of talks about support? The answer is no. And when you look at it, disappointing Q2 data would pile more pressure on authorities. How low does the Q2 GDP print need to be for Beijing to move? And that's why it's going to be important of what are the details of it. And consumption data, private sector fixed asset investment, and industrial value added outputs for signs that consumer and business confidence is finally starting to improve. We don't believe that is going to be the case, especially on the consumer side. China's CPI, again, kind of bouncing along the bottom, but core CPI is still a bit elevated, which it's elevated, but it's come down. So there's nothing here that would keep the PBOC from cutting rates. They can do it. There's not an issue in that in general. It's just what we're talking about is that the impacts or the uplift it will be negligible because they have never tightened. And that, again, if you can't tighten, and as we talk about it in relations to a bow and arrow, if you don't tighten the bow, eventually that arrow doesn't go as far until eventually it just falls flat and just lands right on your foot. And that's where we see a lot of this going in terms of some of these borrowings. When we put it into context, there's typically an increase in borrowing this point in time as you go into the summer months. People increase activity, getting ready for summer demand, summer exports, back to school, Christmas. Excuse me. And when you look at it, we're just not getting it. And it's not because it isn't available. It's because consumers don't want the debt. So yes, you can offer it. Sure, you can say there is 2 trillion yuan available for bonds. And they might say, I don't care because we don't want the money. We can't handle that debt because we're so levered. Our costs aren't going up. We're not making additional money. The global economy is slowing. So there's no way for me to take on this debt, invest it in a meaningful way, and actually pay it back. So that's where we continue to see this underlying cycle as aggregate financing continues to weaken. Cumulatively speaking, again, starting to fall sideways. And when you look at M2 and you look at M1, this is what we've been talking about. Looking at M2, going back to 2016, just look at the levels we're at. We've had a significant amount of stimulus already. It's not like they're coming in after these years of tightening, of these years of being, frugal. They've had very easy policy. President Xi has presided over the largest amount of tax cuts ever in China's history. They haven't raised taxes. And now what are we seeing? We're seeing that local governments are struggling to finance themselves because they don't have the revenue, the tax revenue to do it, which means that they are going to need support from the PBOC, from the federal government to support them. That when you look at LGFVs, interest-bearing debt and payables, here you can see that interest-bearing debt is continuing to increase, but the growth of LGFVs, short-term debt, continuing to go up. So the question is, again, how do they afford it? So you have provinces that have seen their tax revenues fall considerably over the last 5 to 7 years. They've increased the amount of borrowings that they've done. And now you want them, then their interests have increased, and now you want them to borrow more with less tax revenue. And again, this is why they can say it, they can print it, but let's look at the actual money flows and how that's going to move through the system. And you're starting to get an idea of how that's not going to be capable. And here's why. Revenue under local control shrank substantially in 2022. And when you look at a lot of this is because of sales for local governments, but the financial pressure from off-balance sheet local debt is peaking. But as it's peaking, you have a lot of maturing LGFVs. So now you have to get that cycle. So sure, maybe some of this new debt, as we were saying, it's just a cycle. It's just you're replacing the debt that's maturing with the debt you're making available. And that's all this is, to trying to keep this engine running as it's essentially heading towards the end of the track. So local governments experienced large declines in tax revenue and land use right sales last year. A large volume of the local government financing vehicle bonds, LGFVs, are coming due this year, raising the needs for refinancing. And that's why the PBOC is cutting rates ahead of this new round of LGFVs to try to bring down some of those interest rates ahead of some of these roles because there is a significant amount of maturing that is going to happen over this period. Here's where we look at the floors and ceilings. When you look at rates, China's ramping up some policy stimulus to boost its faltering economy. But again, the World Bank, IMF are talking so eloquently about how strong China is and how they're going to carry the global market, but yet we need policy stimulus, and you're starting to see how the absurdity of all of this continues. Soaring debt levels and concerns about financial stability mean the measures are likely to be limited compared with supportive packages in previous downturns. Again, that's what we've been saying the whole time. The law of diminishing returns, the ability to provide the level of stimulus needed to protect growth is going to be very difficult. The People's Bank of China unexpectedly cut a series of different policy interest rates by 10 basis points, paving some of this route. In addition to these monetary policy actions, officials are considering a broader package of stimulus proposals, which include support for areas in real estate and domestic demand. But remember, domestic demand, they've been talking about forever. They've had, the dual circulation, common prosperity, but it has never materialized in a meaningful way in terms of the consumer, because the consumer has a significant amount of debt, has taken a significant amount of losses because of the real estate debacle. And again, there's just this unwillingness to go back out there, especially when you start to see some of these unemployment rates and unemployment numbers and new orders diminishing, not growing. So if the PBOC Governor Yi Gang last week hinted at more policy flexibility, vowing to step up the counter-cyclical adjustments, which is a shift in language. But again, it's very difficult to do this. And the timing of the central bank's cuts may have also been motivated by the U.S. policy decision this week. The Fed is likely to pause rate hikes, which we saw, which would help ease some pressure on the yuan. The Chinese currency has weakened 3.6% against the dollar, which is the worst performing in Asia. But by that weakening, it actually increases exports because it makes it more competitive. So here is where you kind of get some of this back and forth. The China macro optimism is flipping a bit further. That has taken a bit of a pause. There's been some strength into the Chinese markets just because of this hope of stability or support. And our whole thing is that it's just not coming in a meaningful way. China electricity investment in grid infrastructure, cumulatively speaking, is still below where it has been. And it's, as we've been saying, it's going to be difficult to do it because they've invested so much, not only just over the last 10 years, but also over the last 2 years. They've continued to accelerate it, making that investment in grid infrastructure and infrastructure in general difficult to continue, as we've seen here with that chart to the right, the investment slowing down. That's looking at infrastructure. It's very difficult to continue to see this investment, but again, that the good money after bad, the even though it's available doesn't mean you're going to take it. All the while, China's youth unemployment rate hit 12.8% in May, which is a record high. And you see the bifurcation between what is being reported on the official level and then what is being reported on the youth level. Now, breaking it down into different levels, Chinese activity for May confirms April's loss of momentum, driven by construction activity. The supply of residential space fell further to its lowest level since November of 2008, while rising residential demand, barely visible on the chart, remains at the cyclical low. So again, you're not going to be saved by these trends, because when you look at where things have been since 2014 on the China floor space sold, you went up and to the right, without much correction. Obviously, you had COVID, and then you had a massive spike following the 2020. But it's going to be difficult, especially when you start looking at floor space started, because there's still so much floor space available. It's going to be difficult to start new floor space, and especially when you don't have the level of buyers. Property investment in China fell at a faster pace in January through May, dropping 7.2% from the same period a year earlier. New construction starts measured by floor area fell 22.6%, and property sales by floor area declined 0.9% versus 0.4% in the first 4 months. So again, that acceleration to the downside, which is going to be that pressure point. After a strong rebound in Q1, obviously on retail sales remained unchanged over 2 months and more than 10% below trend. The slight rebound in May came from a recovery in car sales, but not and that's why it's like you had car sales, but then when you look at the broader scope, you're not seeing any real meaningful backdrop that's going to send things higher. And one of the things we talked about in retail sales is that it was likely going to go flat before it starts to decline, but we don't see a huge decline. It's just going to be more of this waffling back and forth, or we can call it a chevron pattern to the right. And it's impossible to maintain the trend that was there previously. And you had that big surge post-COVID, the COVID lockdowns, and we don't see a lot of support going forward. Fixed assets investment lost 2.1% on the month, falling further below its long-term trend and driven by all its main components, notably manufacturing, which again points to some of these problems that we continue to see. Especially in real estate, which recorded its sharpest contraction of 21.4% since the inception of the series, and infrastructure, whose spending growth continues to shrink in the absence of expansive fiscal policy. So when you look at infrastructure spending, everyone keeps relying on it and talking about it, but the actual infrastructure spending is diminishing because there's only so many projects available, especially given the quality of the ones that are out there. The combination of retail sales and fixed investment proxy for private demand for April and May point to a first GDP growth figure for Q2 at 2.8% quarter over quarter. Still not a catastrophe, but a sharp drop in momentum, especially when you compare in terms of where Q2 is. It could look pretty good in terms of year on year because of how weak last year was, but don't be fooled by that because, again, we see a lot of those weaknesses. The expected evolution of home prices are the last two major detriments, both of which have rebounded. Taken together, the four factors point to a rebound in Q3 in household mortgage demand and the property market. And now, even though you can get a bounce, you're at such a low point that, again, you will get that bounce. The question is, are you getting a meaningful change in trend or just a bit of a relief? And then you're going to still be at this very diminished or problematic level, especially given the amount of leverage that many of these companies and people already have, which is why we don't see a sustainable bounce in mortgages. Property market continues to be in bad shape. Residential demand is back at the bottom of the cycle and households are no longer applying for mortgages. However, this is a bit of a cyclical trough, which is what we talked about, where you can only go down so much before you kind of bounce. It's because there's still people that are going to look for homes. You're still going to have some activity. So it's not going to be this continuous down move, but you will get some support. We just don't think it's a trend change. Home buyer confidence is one of the main factors behind mortgage demand. It tends to be advanced by 2 quarters and seems to have stopped falling in Q1, but it doesn't mean it had a big bounce. And then mortgage rates are one of the other major factors with 1 year delay with a drop of 150 basis points since its peak. The transmission should start to take place, but even as it's come down, the question is, do people want it? And the answer is right now, no. But we've had such a precipitous drop, you have to have a little bit of that recovery and support, as we've talked about. Now, flipping over to Japan, current survey came in at 55%. Outlook weakened versus estimates to 54.4 versus 56. The money stocks, M2, M3 were kind of right in line with the prior. PPI was expected to be negative 0.2, came in at negative 0.7. That's a nice little bit of a positive. Machine tool orders, though, were expected, last month were negative 14.4, came in at negative 22.2. So you're getting some of that acceleration to the downside. When you look at exports were expected to be down 1.2%, came in up 0.6. Imports were expected to be down 10.3, only down 9.9. So again, a little bit of that stabilization. The question is now, as the yuan weakens, is that going to move some of that activity from Japan back to China because people are just trying to play some of the better opportunities? Core machine orders came in at 5.5% versus the estimate of 3%. So a little bit of that stabilization in general. So when you start looking at some of this activity, we still see kind of a sideways move in some of the underlying economic growth. But the bigger issue for them is the underlying inflation that they continue to face. Because when you start looking at Japan's inflation, it is broadened. So the components of CPI basket that is seeing increases in price, so share of items registering price increases, is at about 85%. versus where it has been in the past, which is anywhere between 50 to 60%. So you see that big increase, and now you had a small drop, and now the reacceleration, which is going to be a bigger issue as the government directed cuts in cell phone charges weighed on CPI for most of last year. But now you're starting to see those increases of the contribution to the headline CPI. Food is going to be a continuous problem, as we've talked about, and that's going to be a bigger issue, especially given the amount of food that Japan imports. PPI, again, you're starting to see that come down, but it's still elevated versus the previous years. And even though Japanese machine tool orders was better than expected, it's still much lower than previous years, which is why we talk about the economic pressure that still remains there, even as inflation continues to ratchet higher. Survey expectations, again, staying towards the highs as the trade balance started to recover a bit. But we see it's kind of flatlining, not really getting a bigger jump, but more kind of getting to a flattish point. India, the PMI composite came in at 61.6, same as last month. Services 61.2, continuing to be strong. RBI kept everything the same. The CPI was expected to be at 4.31, came in at 4.25. Industrial production, very strong, came in at 4.2% versus the estimate of 1.4. Wholesale prices, another nice move, came in at negative 3.48%. Now, the exports fell 10.3%, imports fell 6.6%. So we are getting some pressure on exports and underlying trade, but again, still much stronger than a lot of these other areas, which has been a nice bright spot in terms of India, especially when you look at the drop in wholesale prices and industrial activity. Industrial production is just bouncing around where it has been in previous years, going back to 2013. You can see it's right in line at a fairly stable number, as service business activity continues to be robust without really much break in the slowdown. India index of industrial production still staying elevated. It fell, but obviously it falls all the time at this point in time of the year. So nothing crazy there, with CPI continuing to cool off, which is good because it means that the RBI doesn't have to raise rates. But is there more to that where local demand is slowing, which is also bringing down prices in general? And then obviously it's important to watch on the food side, because with El Nino, they're going to get a lot of dryness. There's going to be some additional issues in terms of finding and maintaining some of their crops. So we do see some pressure here. And again, we do remain concerned on local demand, even as trade continues to be robust. Taiwanese exports fell flat. You can see that it's kind of flatlining here. But as we talked about in segment one, there's a big issue on tech exports, on semiconductor, on storage, and that's where we continue to see some issues in Taiwan, South Korea, and Japan at this point, especially when you start looking at China. And that's where we do see some of these pressures that are going to remain. And if you think about how the World Bank, IMF are relying on these countries to drive most of global growth, it's why we think they remain overstated. So that's what we have for you today. If you have any questions, please let us know. And we hope you have a great weekend. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.